we are in a somewhat of a changing of the tide period. This past September, the Federal Reserve announced that they would have their first cut to the Fed fund rate in 4 years. Now, while we didn't instantly get the major relief in mortgage rates that many people had hoped for, let's take a quick step back and explain how the Fed cuts rates. The Federal Reserve influences the federal fund rate, which that then determines the interest rate banks charge when lending money to other banks to then meet their overnight reserve requirements. Changes in the Fed fund rate then have a downstream effect on short-term debt products such as personal loans and credit cards. The actual impact on mortgage rates is much less predictable. Mortgage rates are not directly tied to the Fed fund rate. So you cannot perfectly predict what a mortgage rate is going to do in reaction to the Fed fund rate. Mortgage rates are decided by the lenders utilizing the Fed fund rate along with other economic factors such as the job market to determine what the actual mortgage rate is going to be. And so that is why when the Feds cut the Fed fund rate this past September, we actually saw upticks in mortgage rates immediately after. This being the lenders had already kind of built in, they'd already started lowering the rates in the weeks prior to the Federal Reserve announcing it. Everyone knew the Federal Reserve was going to be cutting rates. So lenders had started already to slowly cut interest rates. And now what we are sitting at with current interest rates are at about 6.55% when I recorded this episode. They have not really gone down like a lot of people had predicted after the Fed were to cut rates. And one of those factors I feel that are causing interest rates to stay up high is the October job report. It actually reported adding 254,000 jobs, which was 42% more than they had predicted. Now, this will take some time to get mortgage rates back into the low sixes, maybe into the high 5%, as if the Federal Reserve and if these folks aren't careful and you cut these rates too fast, then you can run into other economic issues such as a potential inflation period being created, which we do not want to happen. Now, while interest rates are not dropping at this moment, the important part happened. And the important part was that the Fed made their first cut since 2020. It's a sign that things are headed in the correct direction. The Fed is beginning the process of getting interest rates to a more manageable number for more people in America. And with the anticipation of more cuts to follow, a shift in the housing market is coming. Now the question is, will we see this uptick in the fall-winter months market? We're not yet sure. Nobody knows. Everyone's just predicting things. But one thing that I will confidently predict is that this upcoming spring market is going to be a much more traditional spring market. People are going to be buying, people are going to be selling come spring 2025. As by that point, I would predict the Fed to have cut the rate at least one more time, maybe two more times. So we should be seeing some more relief come spring 2025, where we get a more traditional listing numbers and closed sales data from the past 10 years.